This mistake looks small, assuming your crypto is invisible to the IRS. But starting this filing season, it can cost you a matching letter, back taxes, and penalties because there's a brand new form with your name on it. It's called the 1099 DA. Your exchange is now required to send it, and the IRS gets a copy of every single one. Here's what it reports, what it misses, and how to file right. Let's break it down. First, what changed? For years, crypto exchanges reported almost nothing to the IRS. Enforcement ran on the honor system plus subpoenas. That era is over. Brokers and exchanges, Coinbase, Kraken, and the rest, are now required to report your digital asset sales on Form 1099 DA, starting with sales made in 2025. The forms are arriving now, and the IRS matching computer reads every one. And here it is, the real form, straight from the IRS. The box that matters most is 1F, proceeds. That's the dollar value of what you sold or disposed of. Notice the form also has spaces for the asset's name, the dates you acquired and sold, and cost basis. It's built like a stock brokerage 1099-B because the IRS now treats your crypto exactly like it treats your stocks. Now the trap hiding inside this form, the one that will generate more scary letters than anything else, the basis problem. Proceeds is what you sold for. Basis is what you paid. You're only taxed on the difference. But in these first years, many 1,099 DAs show proceeds without basis, especially for coins you bought years ago or moved between wallets. The exchange doesn't know what you paid. And when basis is blank, the IRS computer sees pure profit. Picture it. You bought a coin for $9,000 in 2021, moved it between wallets, and sold it through an exchange for $10,000. Your real gain, $1,000. But if the 1099 DA shows $10,000 of proceeds and no basis, the matching computer's default assumption is a $10,000 gain. Your records, dates, amounts, what you paid, are the only thing standing between you and tax on money you never made. Let's also kill the myth this form buries for good. Crypto was never tax-free just because no form existed. Selling for dollars, taxable. Trading one coin for another, taxable every swap. Spending crypto on a laptop, taxable disposal. Getting paid, or earning staking and mining rewards, ordinary income at the value received. The 1099 DA didn't create these rules. It created the paper trail. And don't forget the question that's been staring at you from the top of the 1040 for years. At any time during the year, did you receive, sell, exchange, or dispose of a digital asset? You answer it under penalty of perjury. Checking no while an exchange files a 1099 DA with your name on it isn't a gray area. It's a documented contradiction in writing on your own return. So where does it all go on your return? Each sale or swap lands on Form 8949. Date acquired, date sold, proceeds, basis, gain or loss, and the totals flow to Schedule D. Held over a year, it's a long-term gain at the lower capital gains rates, 0, 15, or 20%. A year or less, it's short-term, taxed like wages. Staking and mining income goes on Schedule 1 or Schedule C instead. There's good news buried in here too. Losses count. Sold coins for less than you paid? Those losses offset your gains, and up to $3,000 a year of leftover loss offsets your regular income, with the rest carrying forward. And unlike stocks, the wash sale rule has historically not applied to crypto. Though watch that space, because Congress keeps circling it. If you had a rough year, the tax code actually softens it. Worked example. Alex made 3 trades, sold Bitcoin bought for $5,000 at $9,000, for $1,000 gain, held 2 years. Swapped Ethereum bought for $3,000 when it was worth $2,500, a $500 loss. And yes, the swap counts. And earned $400 of staking rewards. The math, 4,000 minus 500 is 3,500 of long-term gain at 15%, $525, plus ordinary tax on the 400. Notice what made that math possible. Alex knew his basis on every position. That's your action item. Export your full transaction history from every exchange and wallet today while you still can. Exchanges shut down, records vanish, and reconstructing 5-year-old basis is expensive guesswork. Crypto tax software can stitch wallets together, but only if the raw history exists. When the 1099 DA arrives, reconcile it like a pro. Check the proceeds against your records. Fill in any missing basis from your own documentation, and report the corrected numbers on Form 8949. There's a column for exactly these adjustments. Never blindly pay tax on a basis-free number, and never leave the form off your return. Match it, fix it, file it. Quick recap. Exchanges now send the IRS a 1099 DA for your crypto sales. The invisibility era is over. The form's weakness is missing basis, and your records are the cure. Every sale, swap, and purchase with crypto is a taxable disposal. Staking and mining are income. It all lands on Form 8949 and Schedule D. Losses soften the blow, and the 1040 question must match the paper trail. One quick note on who makes this. The tax breakdown is prepared by a tax accountant with over 15 years of public accounting experience, so every figure here is checked against the IRS sources. It's always educational, never advice for your specific situation. Bottom line, the 1099 DA turns crypto into just another reported asset, like stocks, with a paper trail. The winners this season are the people with records, real basis, real dates, honest answers. Export your history, reconcile the form, and file it clean. This is general education, not tax advice, so check with a pro about your situation. Subscribe to the Tax Breakdown for simple tax-saving tips before you file.